Margin in financial terms is the money we make. There are different kinds of margins that the financial community talks about. The easiest one for us to understand is the marginal contribution. That is very relevant for the commercial teams. The marginal contribution is the amount that is left over from the sales after deducting the variable expenses incurred for making the sale. The marginal contribution is a very, very important indicator that would reveal if there is enough buffer for the stock keeping unit to absorb the fixed costs. The marginal contribution in some ways can also be attributed as the acid test for the commercial team to launch and sell an SKU or a stock keeping unit or a product in the market. Normally when you do a selling price calculation, the MC or the marginal contribution is the single most important factor to be looking at. A big marginal contribution percentage of sales indicates that the product is capable to generate more money to absorb the fixed costs that the company will certainly incur. Normally, year after year, we should be aiming to sell stock keeping units or products with a higher marginal contribution. The marginal contribution is greatly influenced by two items: COGS, cost of goods sold, the cost of producing the product, which includes the raw materials, the packaging materials, the variable overheads like labor, energy, subcontracting fees, and number two, the trade allowance percentage. Trade allowance is that particular expense that is spent to promote the product. It's money, the amount of money that is given to the trade for listing our products, for pushing it to the consumers, for distributing it to the point of sales. If more money is spent on either the cost of goods sold or the trade allowance, this will bring down the marginal contribution of the stock keeping unit. A healthy stock keeping unit would normally have a higher than the overall marginal contribution of the business. Now, this would mean that if we sold more of the healthy marginal contribution stock keeping unit, then the marginal contribution of the overall business would stand to improve. Therefore, the marginal contribution is compared on a monthly basis to see if for any reason the sales team is pushing for the sales of an SKU or of a product with a low MC or a low marginal contribution. The other margin, which is very, very important as well, is the product margin. Now, this is the money that the product makes after deducting all the product related expenses from the sales amount. For this, all expenses that can be allocated to the product level are considered. Therefore, expenses like your marketing and general overhead expenses, your other general overhead expenses, your IT expenses that are incurred on the business that are not specific to the product are excluded from the calculation. the product contribution is important to be viewed again for your SKU rationalization or for your product rationalization. Now, some products, owing to the nature of the structure, can absorb a higher fixed cost, thus making them financially invaluable to the portfolio. For example, a product with a very high marginal contribution could have a lousy product contribution owing to a very high absorption of some of the fixed expenses like your factory fixed overheads or your book depreciation. Now, this could be owing to a new additional investment. Sometimes a new product will absorb a higher product-related overheads or may need an exclusive channel in which it needs to be promoted and sold. Therefore, the product contribution should always be reviewed with the commercial team for the necessity of it to be included in the portfolio. The last margin is the profit margin. And now this is represented as a percentage of sales. The margin is the most important indicator for the finance and controlling community, and the commercial one as well, as this margin tells the business owner how much money is being made on the sales of the SKU. So remember, friends, the three different kinds of margins: the marginal contribution, the product contribution, and finally the margin as percentage of sales. These are the three very important margins that any business needs to look into.